You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
No discussions in the podcast are meant as an offer to sell or a solicitation for an offer to buy any security. All investments should be done after careful review and consideration of the investment documents and disclosures. Contents discussed in the podcast are not meant to be construed as an investment, tax, or legal advice. Individuals should always consult his or her own professional advisors before any investment decision.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Today I've got Zach with me again. Hey Zach.
Hey Jack, how's it going? Thanks for having me on again.
Doing great. Today's going to be an interesting episode here, at least I hope it is. We're going to talk about raising money for deals through private equity funds. You know, the reason I wanted you on is I know you're having a lot of the day-to-day communications, both with potential sponsors that, you know, some of which we've already been investing with through the JK funds, as well as a number of potential new groups. And it's not a full pivot, but over the last 6 to 12 months, we've realized it's been harder and harder to raise what I'd call smaller checks from the accredited investor community, and number of factors for that. I think a lot of investors are still tied up in deals from 2020, 2021 that just haven't cashed out yet for various reasons. And I think there's a little bit of fear in the market overall. But maybe let's start out. You talk to investors every day, as do I. But what do you think some of the challenges and factors have been on the kind of retail side of the raising capital?
Sure. I mean, I think it comes down to a number of factors. One that's pretty important to remember is that retail investors also, unlike funds, are not tied to any single asset class, any single investment thesis. So you have a lot of retail investors who have shiny object syndrome. They go for whatever has the, highest projected returns, whatever the media is talking about on a regular basis. Today, of course, Bitcoin at 103,000 as a prime example. We have really just investors who are unfocused and all over the place in a lot of ways. And like you said, the lack of liquidity from deals from the past, really we'll say the past 3 years, means that a lot of these investors are tapped out and they can only allocate so much these types of real estate deals on a regular basis. Whereas funds are constantly deploying into a very specific thesis that they've outlined in an investment mandate from, again, larger investors themselves as well. Some of these funds are raising $50 million up to $1 billion in some cases. And that's all being deployed to real estate, which is a huge, huge difference compared to the retail community that just goes with whatever the hot investment of the month might be.
Yeah. And what's one of the frustrating things is, when you look at least when I talk about the fear and the risk in the market, there's a lot of investors are still trying to time the market, or they think that real estate's going to crash. They think it's going to be like 2008. The same investors that were pouring money, it was easy to raise for a 4% cap rate value add deal in 2021. And now investors are fearful on a 5.5% entry cap rate in an environment where interest rates are going down, where the property is selling for 25% lower than it would have in 2021. So it's crazy.
Yeah, we even saw 7 cap, 6.5, 7 cap deals in, major MSAs in the US where, investors would have jumped at the opportunity 2 years earlier, a year earlier. And it's really the same case where as the deals get better, investors think, I can wait a little bit longer. And that 6.5 cap deal will be a 7 cap. That 18 IRR deal will be a 20 IRR deal. And really, as we've seen historically, that's often not the case. And so the difference with institutions is they see a good deal, they know a good deal, they know that they have a 3, 5, 7 year timeline, and a good deal pencils today, pencils tomorrow, penciled a week ago.
Exactly. Just when you're talking about the waiting thing, I saw Brad Sumrock at a recent event, and it wasn't his event. It was just he gave a quick half-hour presentation, and he just talks about someone waiting for this, waiting for rates to move more, waiting for cap rates, and he goes, if you're a professional waiter, you usually get paid like you're a waiter.
It's very true, and you see it with investors all the time, even when it comes to selling stocks. They think, yeah, this one is still going. I can get another, if it goes from $90 a share to 100, they say, yeah, I can get it to 105. And then all of a sudden it goes to 95 a share. And they say, oh, I don't want to sell yet. I'll need to wait until it goes back up to 100, then I'll sell. It's just, it's illogical in a lot of ways.
Yeah, and that's one of the, as you mentioned, when you start working with private equity funds, family offices, it's very disciplined. It's very much by the numbers, by the metrics. So let's do a deeper dive into that. Maybe we could start with we had a successful closing just very recently. Maybe just talk through the high level of the Nashville deal. Mm-hmm. Which I thought was an amazing deal, and we placed a significant amount of money from a fund into that deal.
Sure. Yeah, this was a deal that came to us from a group that you knew, and really what they came to us with is a distressed acquisition in a major market. In this case, like you said, Nashville. It was a value add play where the previous ownership group had let the property go. They were having issues internally and needed to sell off some of the better assets they had to keep the lights on for their organization as a whole. And really what this group was looking for is they had raised a decent amount of retail capital in the past, but a deal of this size that was, how big was this one, Jack? About 181 units, somewhere around there, where, the idea was to go in, clean up the mess that the previous ownership had, go through and lease up the property, and again, go through and renovate the amenities, renovate units, raise rents, right? The usual Class B value add story in a core market where, the going in cap rate was quite high. It was above a 6, which again is very strong for a market like Nashville. And really, this is the kind of deal that this fund had been looking for, but hadn't been able to source on their own. And what happened when they went through is they were able to do a full site visit, multiple calls with the sponsors in a very quick and timely manner, right? It wasn't chasing, following up, saying, can we get on another call? Can we get on another call? Because this is what these funds do every day, is they have capital that they need to deploy, and they need to find the deals to do so, which they can't always do at the scale that they need to be able to go out and invest $5, $6, $10 million at a time. With this one, they understood the market because Nashville is one that they'd studied closely. They saw the value add potential, and they understood the distress of the situation. Also important to note that this particular deal involved assuming a Fannie loan. And so this is one where, this group was actually able to come in with some real value add and help work through the process, rather than, an investor might say, oh, why didn't we close yet? Why didn't we close yet? When's my first distribution? This is patient capital that sees the opportunity, and they were able to go through and move forward and come on as, a key partner in the deal.
Yeah, this was a great success story. I'll just add that this group, and I'd say a majority of the groups, they are passive, but they do need key decision rights and sometimes more reporting. But they definitely do want their partner, whether it's set up as a JV or whether it's just set up as limited partner equity with with co-GP or with a side letter that gives them certain control rights. And it's usually around key decisions, sale, refinance, major expenditures, just really sticking to the business plan. It just gives them protection. And if you're writing a multi-million-dollar check, it just makes sense. You're going to want more control, just more protections than, the investor putting in $100,000 into a deal.
Right. No, this group put in, if I remember correctly, they were about half of the equity in the deal. And so those are the kind of things that you can ask for when it comes to a quick turnaround. Some of these groups need 30 to 60 days, for example, compared to a retail investor might need the same amount of time. They might need less. They might need a couple of days. But I would much rather spend 30 days for, a $5, $6, $10 million check than have the same amount of time for every $50,000 check, $100,000 check that comes in the door. And then if you do have any kind of an issue, this is one where they will be able to actually help because this is what they do on a daily basis.
Yeah, and that's something that with our own funds we're paying. It was always something we paid attention to, but now it's becoming potentially a deal maker, a deal breaker, even on our personal investment decisions. Are who are the other investors in the deals that we're investing in? I mean, we're investing sometimes $500,000, $1 million into a deal. We don't have the type of capital to just write a $10 million check from our own pockets, but we actually like deals that have someone with deep pockets alongside us, because if there is a capital call, and we've seen a few of them on deals. I mean, I think the industry in general, most of us have seen capital calls on 2021 assets. Knowing that there's a big check writer who could actually make the capital call, it makes the deal much safer than if you're invested with 100 people that all have $100,000 in, and you're trying to herd cats into raising capital to protect a deal. So I think it's a very good thing to have institutions alongside of us. So let's talk about some of the underwriting and the things like in today's market. Just what are the funds looking for?
Yeah. So what I've seen recently is that in a lot of ways there are similarities between retail investors and private equity funds, institutional investors. Is they have a certain metric that they want to hit, whether it is cash flow, whether it is IRR driven. But with these funds right now, they are looking for distressed deals in a lot of ways because they know that they're out there. Because it's harder for deals to pencil now with debt costs being so high, interest rates being high, they need deals to pencil typically with quick cash flow, year one cash flow, 4 or 5%. And the idea is often that is one of the core reasons for an acquisition right now, is how much distress is it and how quickly can we get back to some sort of stabilization. In some markets, there are areas where rent growth may not be high right now, but their thesis is that in the next 2, 3, 4 years, wage growth, job growth in particular markets is set to increase more than others. So most of these funds are very geography specific, whether it be certain states that they love, that they are non-starters. Some might say, yeah, there's too much supply coming in, so vacancy rates are too high for our liking compared to new supply coming online. Those are things where you'll know right away in the first email or two if a deal is going to work with a particular fund or not, and they'll tell you exactly why. Retail investors might say, I'm still looking into it. I'm still thinking about it. I'm not sure if this is right. And you either have to push them over the line and say, this is a great deal, go for it, or not. And with funds, they're much more straightforward, saying this doesn't meet XYZ criteria. Bring us something that does, and we'll write the check.
Yeah, that's definitely it's easier in many ways. Although there's times where if it doesn't check all the boxes, we've had deals that I think even some of our private equity counterparts have generally liked the deal, but it's just not going to get through committee because of it missed one or two of the metrics, and the committee stays disciplined, or they're just legally obligated if there's certain criteria from their fund that they've signed off on, and they're legally required to just ensure that every acquisition meets those standards.
Right. At the same time, that also means, again, it's good to get a quick no, but also along the lines that you just mentioned about their legal obligations. I think it's really important to note that, again, these funds are legally required to invest capital, and they have a set mandate that they need to invest X amount of capital over X amount of time. And at the end of the day, if they don't do it, they have to give the money back. If a regular accredited investor decides to invest their last $50,000 into a syndication, great. If they decide that they're just going to leave it in a high interest savings account, they can do that. Whereas these funds are searching all day, every day, going through hundreds of decks a week, really because they have to invest, and they don't make any money if they don't.
Yeah, it's a very, very good. Yeah, the acquisitions people are definitely, they're hungry for deal flow. They want deals to happen. All of them, especially our day-to-day counterparts that are reviewing the deals and advocating if they see one they like, as they're pushing it up the chain through the investment committee. It's a great, our interests are definitely aligned. What are some of the key financial metrics in today's market? Just I'm thinking kind of the cash flow versus overall IRR, annual returns, et cetera.
Yeah. So we're seeing much more of an emphasis from funds on year one cash flow, largely because, again, the idea is that these are distressed acquisitions where you can go in and add value quickly rather than having to play the IRR game and wait for these large returns like you said we were able to get in 2021, parts of 2022, where you're able to go in, renovate quickly, and sell for a huge profit, like a few of the deals that we had in 2021 and 2022. So there's a lot more of a focus on cash flow. And at the end of the day, with all the new supply coming online, if you can come into a deal and optimize operations, you have a property that is underperforming on the leasing side of things. For example, if it's at 60, 70% occupancy, you can go in and you can fix that up. And that's really been the play for this property in Nashville, where the occupancy was in the low 60s, and now it's in the high 70s. And there are some units that are offline for renovation, so it's really closer to 87% occupancy when you factor in the units that are offline. So those are metrics. And then when you look at market as a whole, when they're looking at these MSAs, they want to see how the vacancy at this property compares to the rest of the area. If this is a city that has average occupancy in the 70s, they're not really going to want to move on that market. They will look for another one, though. And that's the thing. So if it's not a deal because wage growth, job growth are not hitting where they should be, if occupancy is low across the market, they're not going to have the same urgency to move. Whereas if you have one property where it's the least occupied in a 5-mile radius in an area that does have some sort of job and wage growth, that's a pretty interesting value add opportunity. And it's one where you can really see it in the cash flow early on if you bring on a strong leasing team.
Yeah, absolutely. The distress is interesting now because it's not, I talked in the beginning of the show about people that are thinking, waiting for a crash. I'd say in commercial, it's somewhat already happened. And, I think we're already probably past the tipping point. It's just quieter because it's very much a niche. It's a niche of select deals that had bridge debt from 2020 through 2022, right before rates moved, and where they thought 3 years would have been enough, and interest rates have been up for a more prolonged period of time. And add to that the oversupply in some markets that have just caused properties to underperform projections, and many groups are just hitting that window where the ones that aren't well capitalized or don't have a good relationship with their lender to extend are really forced to sell. Those that had 10-year fixed rate debt are riding high and have a 3% rate and no reason to sell. So really the only deals that are hitting the market usually have some type of challenge or their assumptions. I think there's the few deals that have successfully sold at good outcomes were loans that had a loan assumption. And I think that's one area that private equity funds can shine a bit as well, because you might only be assuming a 55% loan to value for if you're assuming a loan. Some of these private equity funds, they don't mind writing $10 or $15 million checks and
That's
taking
what they do.
a 3% loan. And
Right.
maybe they'll do a supplemental, which is similar to a cash out refinance in the future to just increase their return, their overall ROI. But yeah, they're not shy to write a bigger check if if it's a lower risk, higher cash flow deal. There's certain
they prefer that.
certain funds that come to mind that want the higher cash on cash return just don't mind lower leverage.
Right. No, at the end of the day, lower leverage for them just means higher cash flow, less risk, and they don't need 80% LTV on these deals, hoping for, again, the big IRR cash out in 2 to 3 years. Right. That's just, it's not necessary at these larger groups. And when you look at a lot of the deals that we're seeing sell right now, I mean, I've been having maybe 15 to 20 calls with operators per week at this point. And a lot of the deals that are being acquired for the cost of the outstanding debt. And that just shows where we are in the market cycle, where there are some operators who were too aggressive in their underwriting as well. They thought that, they could go in and evict half of the tenants and double the rents and renovate to the highest possible standard. And that really just isn't realistic. And that's one that a private equity fund will be able to see through right away, that the average accredited investor might just like the high IRR that they're being promised in a lot of ways that hasn't come to fruition.
Yeah, and for those funds that do look for the higher IRR, I mean, I know build to rent is something that we're paying close attention to as well. So
absolutely,
even with high material costs and higher construction loan rates, there are still opportunities to build at a substantial discount to the market value, and those are also much shorter term deals. Those are 18 months, 2 years in some cases, if you're coming in right when it's shovel ready.
Right. Yeah, no, and we were talking about this yesterday with some of the new data that came out from CoStar, where the number of new construction properties going up right now compared to 2 years ago is, night and day. And so really, right now, there might be an oversupply in some multifamily markets, some that come to mind, Phoenix, Austin. But 2 or 3 years from now, there will actually be a lack of supply in these markets, just because I think I saw Houston specifically had 2 years ago, they hit their peak of new construction with about 4,000 new units being built in, I think it was Q2 of 2022, somewhere around there. That number is down to 300 for Q3 of 2024. That's just not sustainable Houston's the third or fourth largest city after Chicago, or right there with Chicago, for largest city in the country. You can't have a lack of supply like that not being built. It's just, it's not sustainable. So this is one where, build to rent can really shine over the next couple of years, especially as, there aren't as many, great Class B value add deals as we saw over the last 18 months.
Yeah. And one of the things, it's definitely a different market than the Class A new construction, but we have seen a bit of trickle down. The new Class A does a concession or 2 months free, and then the former Class A, or still the Class A, we'll call it a Class A minus, has to drop their rents $100, $200 or offer incentives. And it did kind of trickle down where I think the top end of the workforce housing Class B tenants maybe had an opportunity to get into a Class A and made that jump, especially when the economy is largely doing well, unemployment's low. Inflation certainly hit a segment of the market, but there's still a lot of people doing pretty well, especially in these high growth cities with a lot of job growth. So it certainly had an impact. But the bull case is that, as you said, in 2026, all of the current units that started building in 2020, 2021 are now coming online, and all of a sudden, vacancy rate is sub 5% in a city, and there's just not really those discounts available. You couple that with interest rates stabilizing, and who knows what happens with the 5 and the 10 year. The market somewhat controls that, but with the Fed hopefully continuing to keep the short-term rates lower, my hope is at least keep the 5 and the 10 year stable. We've seen a 1 point fluctuation even this year. The 10 year got as high as 4.6 and as low as 3.5 or 3.6. So that's a pretty massive move in a year, especially when you're if you're under contract on something and trying to figure out what your debt looks like. Hopefully that stabilizes. And I know that the funds are all, a little more sophisticated and trying to, map out where rates are and, time it and lock in.
Right. Well, and, one thing that I will say is the same, whether it is accredited investors or private equity funds, is none of us have a crystal ball. The question is, what do you do during these times of uncertainty? And that's where, a lot of these groups that have more capital to deploy are saying, could the 10 year move? Could the 5 year move? Could this change macroeconomically? Could World War III start? Whatever the question is. The question is always there. What happens is what you do with it. And these groups are saying, these are the best deals that we have seen in 12, 18, 24 months. They're available now. We don't know if they will be, but we know this is the best that we're seeing, and this is the best we have seen. We have to pull the trigger on it. And that's where, fortune favors the bold, right? So, this is one where these funds are actually sitting on the sidelines even less during this time They're actively reviewing more deals than ever. They're being more selective than ever, but they're going through and reviewing more deals and more deal flow than ever.
Yeah, it's definitely important to have this as another option. There's definitely a lot of syndicators, sponsors that were successful for years just raising their own money and just from their friends, family network. And even those that have had no issue raising capital over the last 10 years are starting to look for additional options, just because even with success, some of their investors are just tapped out because they're in other deals, maybe even other deals with other groups that are unrelated, but liquidity is a little less than before.
Yeah, well, and along those same lines, raising this type of capital is ideal for the sponsors and the operators who are looking to really scale. A lot of them have built strong track records with smaller properties, 20, 30, 50, 70 unit properties, and they've always been able to raise that much capital. This is the one where a lot of operators are now able to, again, if they can bring in that one check writer for 5, 6, $10 million, that puts them into another league when it comes to being able to make the 30, 40, $50 million acquisition and really be able to operate at scale, whether it's by building in-house property management or being able to get great terms from a third-party operator and be able to scale within these hyper-focused geographies where I've spoken to a number of operators who are very good in their core market where they might own 5, 6, 600, 1,000 units within a 30-minute drive across 3, 4, 5 properties. And so being able to come in and have that anchor investor makes scaling the business much easier.
Absolutely. And there's the funds, many of the funds are fine working with sort of that up and coming sponsor syndicator, especially the ones that used to be operators themselves or are not afraid of operating. And sometimes they can actually provide, some minimal amount of help and assistance to make sure that, the sponsor who has this really good deal and a good operational track record is able to handle the reporting and work together with them. And, they want to add value where they can because of their experience. And then there's other groups who really want groups that are really established with infrastructure and are used to the level of reporting that some of the more institutional groups need. And one of the antidotes I'd heard is they're fine with the up and coming group, especially if the founder had an institutional background. So, one of our deals that was successful, relatively, company's been around for a few years, but the main partner used to work at a REIT. So he was on the institutional side, knows how to speak the language, knows all the reporting, and is now on their own. So that can be a big benefit as well if there is the corporate background, but now the team is more entrepreneurial. Where I think people may challenge is if it's like that club syndication where a couple of people went to a course and are kind of throwing money into a deal. Those are a little bit more challenging, but the groups that have a real infrastructure, a growing track record and are, scaling up, those are great fits for a majority of the private office and our family office or private equity funds that are programmatically investing in the space.
Sure. Yeah, no, I mean, what we've seen is that there's a lot of emphasis on the team when it comes to the investment. Similar to, we see the same approach in early stage venture capital is this the team that can go through and build out what it is they say they can on paper? And, you really have to look at the track record, whether it is as an existing company or in a previous walk of life. There's one, great conversation I had with an operator recently who is working with these partners really for the first time this year, but they all have different skill sets where they brought in family office experience on the asset management side. They bring together capital raising on another. And then the lead partner on the deal is a 25-year general contractor in the same city where this deal is being done. So you can really bring together the right pieces to make a deal pencil and to really be able to believe that this is the team that can execute on the business plan, because maybe they haven't done it together, but they have done it individually in these different periods of their professional careers.
Yeah, absolutely. So in closing here, let's talk about the type of information a sponsor needs to provide for us. As part of we've had success in bringing a number of these funds into the same deals that we're looking at to invest in ourselves. And I think it's really helped us because we're investors already. So as we talk to some of these funds that are really too big to invest inside one of JCAM's investments, but they're often just investing alongside of us into the same deals. And again, they may get, similar special terms just because of the size. But what are the best types of deals, and what should the operators or sponsors be sending us for, potential investment?
Right. Yeah. Really what we need to see is an LOI on a deal. And that's really step one. No one is going to invest in a property that you hope you might get under contract, you've been looking at for a while, that you're thinking about pulling the trigger on. They need to see conviction. They need to say that whether you're in or not, this is a great deal, and we're moving. We're in the 30-day due diligence period, 60-day due diligence, whatever it is. So that's step number one. Two, they love to see current rent roll and understand really what is happening at this property. What is the occupancy like? What are the rents like? Because they can really go through and do their own market research. So it's not like a lot of the, smaller investors who will need to be educated on Nashville, will need to be educated on Dallas, Houston, whatever the market is, because they don't have the same insight and understanding. They pay thousands and thousands of dollars a year for data. They don't need a CoStar report. They pull that themselves. They do their own underwriting. They follow their own trends where they say, yeah, you have an aggressive underwriting here for wage growth in the area. We don't think that you're going to hit that. And we have our own data to show it, right? So that's another important piece. And they need to go through and see the deck and understand what the first 3 years look like from a vacancy perspective, from a renovation perspective, and again, wage, job, rent growth in a particular market. They need to see the track record of the team. Is this their first deal together? Is this the largest deal they've done? Again, these kinds of factors. Then they also need to understand property management. Is it going to be managed in-house or by third party? Sometimes that is something where one group likes, the other doesn't. And then one thing that we've seen a lot of demand for recently is any kind of tax abatement that is available. Because property taxes, in some states can be quite high. And if you have a way to show, for example, on the rent roll, that if you keep 20 to 40% of the units in some sort of affordability range based on the area median income, then you're able to say, yeah, if we drop rents by 2%, we'll be significantly more profitable because we won't have to pay the property taxes based on a partnership with whatever local housing authority it might be. So those are kind of secret sauces that a lot of these private equity funds like to see, and that they look for very early on. Also to understand the level of sophistication from the operator and being able to work on that type of a transaction and be able to build these partnerships with local authorities, nonprofits, et cetera.
It's a great summary. And hopefully, we've got a lot of investors listening, and I know some of the sponsors and our partners also listens. Hopefully we can help get some of these deals done in 2025 and just create a bunch of win-wins like we've always set out to do. So I think we've covered a lot here today. Zach, thanks for joining. And everyone, please remember to like and subscribe on YouTube, iTunes, Spotify, and connect with us on LinkedIn, Instagram, Facebook, TikTok, and any other social media platforms. So thanks again for listening. We'll see you on the next episode.
Thanks, Jack. Thanks, everyone.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.